Kevin Prendergast, Director of Wealth Management at the Retirement Network, Leland Smith. I'm recording this video on Tuesday, March 21st, 2023. Going to get into the February 2023 minimum present value segment rates recently published to the IRS website. But first, a quick thought on recent headlines. A lot of talk over the last week or two about bank failures or bailouts or crises, whatever kind of loaded terms the media likes to use. And it's instructive. The last 1 to 2 weeks have been instructive in that I think we're all, on some level familiar with the media's business model, which is to get and keep our attention so that they can place advertisements in front of us, and then their revenue is derived from those advertisements, right? So there's kind of a war for our attention. And while the methods have perhaps changed over the last decade or two because of social media and things, a common tactic remains that the whole fear sells, or if it bleeds it reads type, or leads. I'm not sure what the right term the exact phrasing is, but this kind of fear sells tactic is a common one, which is that the media tends to grab onto these negative headlines and kind of make it seem like the sky is falling every day, because it's a pretty effective tactic to get eyeballs. And the last 1 to 2 weeks have been instructive in that had some very negative headlines, some pretty meaningful banks that required some emergency measures, shall we say, and the stock market was overall positive, and in many cases substantially so. Just kind of counterintuitive, and it's instructive. We can think about COVID 2020, very negative headline, of course. Stock market was very positive in 2020, very positive in 2021. So it's a good reminder that to sell out of stocks because of headlines, or to change one's investment strategy or approach based on headlines, it's a really, really difficult way to invest, especially over the long term being defined as 5 to 10 plus years. Trying to invest that way based on headlines and moving in and out based on one's interpretation of headlines, it's really hard to do. It's really hard to do. The market can often behave in counterintuitive ways, right? Negative headlines, positive market performance, as was the case over the last week or two. So probably best to pick a very reasonable approach. Like in the 401k plan, for example, there's some good low-cost index funds available in the 401k retirement savings plan. Good idea to just every pay period consistently invest in a way that you're comfortable, and resist the urge to tinker based on headlines, because it's really, really hard to do, and especially it's hard to get it right. You might get it right every once in a while, but to get it right consistently, time and time again, over the course of decades, right? This money is not just to get you to retirement, but through retirement as well. It's a really, really hard way to go. Okay, so with that established, let's get into the latest and greatest rates. And as always, if you'd like to schedule a conversation with one of our advisors, feel free to reply to the email containing this video. We do monitor that inbox, or visit our website, retirementnetwork.com. Click the Get Your Free Assessment button. All right. February rates picked back up. So again, for many folks, if you were to commence a pension lump sum, not a monthly annuity, but a lump sum in 2023, your lump sum is likely calculated using these rates here, the November 22 rates, which are higher than 5 across the board. We saw that in the first couple of months since then. So the December, January kind of ticked lower. Now we've ticked back up as of February. Interest rates have been extremely volatile unusually volatile since the Federal Reserve began engaging in these policy measures in an effort to fight inflation starting early last year, early 2022. So interest rates have been highly volatile. If you're still with the company, you probably did so for one of two reasons. One, maybe you intend to work for the company for a number of years more, so you're not too concerned about the November 22 rates, or you plan to take the monthly annuity rather than the lump sum, in which case these rates are not impactful. Another scenario that we've gotten some feedback on is if you are already age 65, especially if you turned 65, a few years ago, generally your rates are locked in at whatever the prevailing November rates were at that time. So if you are over age 65, let's say you're 67 or 68, These November of 22 rates might not impact your pension lump sum. That's another important factor. That was a great piece of feedback we received on last month's video. All right, hope this is helpful. See you next month. Bye.